Hey, good afternoon, everybody. It is 2 o'clock. It's actually 2:01, and we didn't want to keep you guys waiting. So we're going to go ahead and get started with today's 1031 Exchange webinar. So before we start off, I do have a couple of housekeeping items. First and foremost, what we want to do is make sure that you leave here today with all of your questions answered. So if you have, during the course of the webinar, any pertinent questions to ask, please do type your question in to the chat or the questions dialog box and hit submit, and your question will pop up on my computer screen, and we will address your questions as they are pertinent. So you might be asking a question that we're going to answer later in the presentation. Don't think we are ignoring you. We'll probably just get to that later in the presentation. But if you do have questions, we do certainly enjoy them, and we want to make this presentation as enjoyable as possible. I don't think I have any other housekeeping items, so hopefully you guys can all hear me. Hopefully you guys can see me, Phil, and Adam. And let's go ahead and introduce ourselves. So Phil is here. And Phil, give us your background, who you are, and everything about you. Not everything.
Well, not everything. Hi, Leonard. Good morning, good afternoon, everyone. I'm Phil Atwan. I know so many of you that are out there right now. I'm so honored. After I retired, I actually came back in the industry a few months later, and I landed up here at Asset Exchange Company. I am very thrilled about that, and I'd like to introduce to you my right-hand person, my team person, which is Adam Nishikawa. In fact, today I was speaking up in Monrovia, and somebody said to me, "Who the heck is Adam Nishikawa?" And I said, "He's a good guy. He's on our team." But I'm really happy to be here with you. I've been in the industry since 1982. When interest rates began to come down, they came down the day I came in, down to 18.5%. Of course, life changed. And the bottom line is I've been with you for all these years, the last 27 years in the area of a 1031 exchange, which I think most of you know. But anyway, thank you, Leonard, for having me here today. I'm really happy to be here. And thank you, Adam, for being such a good teammate.
Hey, Phil, Sharon Tsukamoto says, "Glad you're back, Phil."
Thank you, Sharon. I'm so thrilled. We're going to be speaking at your office in a couple of months, so we are looking forward to it.
Yeah, we're really excited to get Phil, but the way we got Phil was we first hired Adam Nishikawa. Adam, why don't you let everybody know about your background and et cetera.
Yeah, of course. Hello, everyone. I started in the commercial real estate industry and got recruited into the 1031 exchange side because I saw how much good it could do. Nobody wants to pay taxes, so I was like, well, you know what, this is a product I can stand behind. And so for the last 9 years, I've been doing 1031 exchanges, and I'm thrilled to be on a team with Phil in LA and just conquering as many 1031 exchanges as we can possibly find and helping people avoid paying taxes.
Well, Cheryl Lynn Johnson says Phil is amazing, and Cheryl, Adam is amazing too. So next time you have an exchange, you're going to be working with both of them, because the way that we are running our Southern California territory is Phil and Adam are a team now. So if you work with Phil, chances are you're going to work with Adam as well. So these two guys are going to be at your beck and call anytime you need it, and they're operating as a team. So very super excited to have both Phil and Adam running Southern California for us. So let's kind of jump in, and if I'm going to ask you guys a question real quick. Can you guys see our faces and the screen? Maybe Cheryl or someone? Yes. Okay, perfect. Cheryl, let me know you can see us both. So good, fantastic. So good. So I'm going to go ahead and kind of just run through. So most of you guys, if you know Phil, you know what a 1031 exchange accommodator is, right? So we are a required part of the 1031 exchange process. We're going to hold all of the sale proceeds, prepare all the legal documentation, and make sure that your clients are in compliance with the rules and regulations set forth in Section 1031. Now, you might, if you work with Phil before, I think you know Phil's old company, but you might not know his new company as well. So the new company Phil is with is Asset Exchange Company, and I started this company with my partner, Adam Skarsgård, back in 2006. And our company, we are a full service accommodator. We do all types of exchanges. We're insured and bonded through Adam Skarsgård, our tax attorney. We're also a member of the California State Bar. One of the unique things about us is we do provide free audit support for clients who get audited. So hopefully your clients don't get audited, but if they do, we can help substantiate the position they took in their exchange. Now, we cannot represent you in tax court, but hopefully we can help you avoid tax court altogether. So we've been around a long time and really are trying to beef up our Southern California presence with both Phil and Adam now. So Section 1031, most of you know, it is one of the single greatest wealth building tools available to the real estate investor. Section 1031 allows you to sell your investment property and defer paying capital gains taxes. So, Phil, tell us about those capital gains taxes. I know you go over this in all of your presentations. So what are we looking at when we're looking at federal taxes? And then I'll pass it over to Adam for those state taxes next. What do we have, Phil, on the federal side?
Well, a lot of folks call me up and say, Phil, you know, I'm not sure I should do a 1031 exchange. I'll just pay 15% of the capital gain and it'll be done with it. And I say, excuse me, 15%? Do you know there are 4 actual taxes you pay when you sell an investment piece of property? First is the long-term capital gains tax. Average is between 15 to 20% of the gain. A lot of people say, well, I don't have a lot of gain because I refinanced the property, took a lot of equity out of it, and I say, time out. That isn't how it works. The gain has nothing to do with the equity. This is not an equity tax, whether you have lots or little. It's a capital gains tax of which the CPA has to figure out what the actual gain is. Roughly the sales price minus the adjusted basis equals the capital gain. Whether you have the equity or not is not an issue to the government. That's what you pay. The second tax that you pay, it's the health care tax, the Medicare tax. Some people call it the affordable health care tax. I really don't care what you call it, but here's the bottom line. If your net gain is at least $200,000 or more, you pay, in addition to the 15 to 20%, you pay an additional 3.8%. If your gain and you're married is at 200 or 250 or greater, then you pay that additional 3.8%. That applies to all real estate sales. It doesn't matter if it's an investment property, second home, a vacation home, or your principal residence. And in addition to that, it also applies to your stocks and your bonds and your mutual funds. So those are the 2 big federal taxes, but then there's actually a third federal tax, but that may not be my part. Is that Adam's part?
Yeah, no, go for it, Phil.
Okay. When you buy an investment property, you're going to take your closing statement with you to your CPA, and they're going to create something called a depreciation schedule. They're going to look at the value of the property. I paid $1 million of the property, or they're going to assign a value to the actual land and the improvement on the land, the building. So the land value plus the improvement value equals your $1 million purchase price. The government says, now you have an allowable depreciation rate of whatever the value of that building is, and then they're going to divide it by 27 years, or 27.5 years, if it's a investment property, right? And it's residential. And residential, yes, is 1 to 4 units, but if you have a 250 apartment unit building, it's still considered residential. Though your lender may call it commercial in terms of its loan, it's still a residential building because it houses people. And you get to deduct that depreciation every year against the income that comes in, which means you pay less income taxes on the rent that you collect. So that depreciation is wonderful. It's limited, but it's spread out over the 27 and a half years. Commercial is a little different. It's actually the same, but it's divided by 39 years as opposed to 27 and a half years. So when you sell the building, the government says this was an allowable depreciation. Allowable means you can either take it or not take the depreciation. But whether you do or you don't, at the end, when you sell the building, you have to pay a 25% tax on all the allowable depreciation, whether you took it or not. So for example, if you have $400,000 worth of depreciation, 25% tax of $400,000 is $100,000. Plus, if you sell it for, let's say, $3 million, you bought it for $1 million, let's just assume the gain is roughly $2 million. Then you pay the 15 to 20% tax on that, plus the additional 3.8% tax. But yet there's more. And Adam will talk about what the state of California is going to do to you when you sell that property.
Yeah, and before we pass it over to Adam, I do think one of the things that Phil mentioned is extremely important to note is that you're going to pay this depreciation recapture tax if you cash out of your property, regardless of whether or not you actually took the depreciation. So every once in a while, we'll have a client that says, well, I'm not depreciating this rental property. And that's a very big no-no. If you own a rental property, any type of investment property, you need to claim and take that depreciation write-off because it's a tax benefit in the year that you take it. And then if and when you cash out of that property, they're going to tax you as if you took it, even if you didn't. So always, always, always take your depreciation on your investment properties. It's a huge benefit while you own it, and they're going to tax you as if you took it, even if you forgot to take it. So make sure you're claiming that depreciation. So federal taxes, very well explained. Thank you, Phil. What about the state? What does the state of California do? I think everybody, or at least most of you guys are in California. Adam is in California. What is the state going to do to us, Adam?
Well, the state's going to tax you again. You know, you're going to have potentially as high as 13.3% in state capital gain tax, which is of course based on your income level. So you want to make sure you talk to your CPA and see what you're going to owe at the state level. And then going even more in depth for the state of California, let's just target Los Angeles, right? There's a ULA transfer tax on the sale of residential and commercial property that exceeds $5 million. And that ULA transfer tax is an additional 4% to the city of Los Angeles for being successful in owning real estate that is appreciated above $5 million. So between all of these taxes, that's a pretty considerable tax burden.
Leonard, can I jump in on that one?
Yeah, absolutely.
Very interesting, folks. You know, the feds talk about the long-term capital gains tax, but in California, when you sell a property, it goes into your ordinary income tax bracket, which jacks up your income tax bracket, not just on your earnings, but that real estate as well. So that will probably propel you to even a higher rate. And the state of California has just recently taken an increase, and now it's 14.4%. So the bottom line is, it's the bigger your gain, the more you're going to pay, not just on that California state tax, but on your ordinary income tax for your business.
Yeah, I mean, the bottom line is it's just ugly, right? And real quick, what Phil was talking about is it's very important to note that, you know, a lot of people get confused on what they're actually taxed on. And what Phil had mentioned is you're not taxed on your equity and you're not taxed on your cash. You're taxed on your gain. All right. And I think most of you guys are on the phone or real estate agents or real estate professionals. You're not CPAs. So you don't want to do math and calculations for your clients. What I always just tell people is the kind of rule of thumb is about 1/3 of your gain is going to go to pay taxes. And, you know, that begs the question, well, what the heck is my gain? And Phil kind of touched on this earlier. Your gain is a function of your sale price minus your basis. Your basis is your purchase price minus your depreciation plus your capital improvements. And we have some worksheets that we can forward over to you just to give your clients kind of a back of the napkin number. You know, these aren't rocket, you know, it doesn't require rocket science to figure this out. So let's kind of just do a real quick run through here. If you had a client that owned a property and they originally bought it for $500,000, they've owned it for, let's say, 10 years, so they've taken about $100,000 of depreciation. They put a new roof on that cost $25,000, and then they sold the property for a net sale price after commission and closing costs of $1 million. Their basis is where we want to start to figure out kind of what their tax implication might be. So the basis is pretty easy. You take your purchase price of $500, you subtract out your depreciation to get, and you add back, sorry, camera keeps popping up. You add in your capital improvements to get your basis. And then if you sell that basis for anything above, or sell the property for anything above your basis, you're going to have gain. And in this example, we said that we sold our property for $1 million. So we've got $575,000 worth of gain. All right. Now, what you're going to do is you're going to take that gain to the CPA for an exact number, but what we want you to be able to feel confident about is about a third of that, 33%, is going to go to pay taxes. So if you want to just give your clients kind of a very high level estimate of what their gain is going to be, just say, hey, you've got about $575,000 of gain, a third of that, maybe about 150, 200, somewhere around there. If you give them that estimate, they're going to be very, very close to what they're actually going to pay if they cash out. Now, how many of your clients want to actually pay taxes, especially when it's, you know, six figures like that? Very few of them. So the good news is you've got a lot of options when you sell real estate in terms of getting rid of or mitigating that tax liability. Now, if you're selling an investment property, which is what we're here to talk about, you can defer that tax liability completely with the 1031 exchange. Now, please do not confuse Section 1031, which is applicable for your investment property, with Section 121. Adam, you want to tell us real quick what Section 121 of the Internal Revenue Code is?
Yeah, Section 121 is only for primary residence properties that you've lived in for 2 of the last 5 years. So if it was your primary residence for 2 of the last 5 years and you haven't used your exclusion on any other primary residences, you're eligible for $250,000 of the gain tax-free if you're single, $500,000 if you're married. And that's only for primary residences, not for second homes and not for investment properties.
Yeah, so 2 tax laws, very, very important. And a lot of people get confused on how these are applicable, right? So Section 1031 for your investment property, that is a tax deferral. Section 121 only for your primary residence. And this is a great one because it's complete tax avoidance. Now, one of the cool things about these tax laws is that they are not mutually exclusive. And what I mean by that is you can use them together on the sale of one property. So let's say you have a duplex and you live in the top unit and you rent out the bottom. If you go ahead and sell that property, you can actually apply Section 121, the homeowner's exemption, to the top unit, the portion of the property allocated to the top unit, and then you can actually do a 1031 exchange on the value of the bottom unit. So Phil, not just duplexes, but what other type of properties can you take the homeowner's exemption and the Section 1031?
Well, obviously it's principal, and remember, it's up to $250,000. It's up to $500,000. And the second comment I wanted to make about that is I was recently speaking with one of the board presidents here in Los Angeles County, and I called him just to let him know that I moved and whatnot. And he said, well, you caught me. I'm in Washington, D.C. right now. In fact, we're going to be talking with Congress. We're talking to them about putting them it's called the Big Beautiful Bill or something like that, yeah, that they're trying to pass. Well, they're talking about raising the $500,000 to $1 million. and of the 250 to $500,000, especially because these coastal properties, because of all the appreciation that's happened, it's just going to give them some tax relief. So we'll see what happens with that. I don't know, but we'll see what happens.
Yeah, how great would that be? I mean, if we could get this up to $1 million for married couples, that would be more realistic, because then, I mean, this hasn't changed forever, but inflation just keeps going up. So that would be fantastic.
Absolutely. So we'll have to stay tuned and watch the news and see what happens. I do know that, like, for example, the seminar I was speaking at this morning, some of the agents were saying, well, how about if I use part of my house as my office, and then I can deduct that and then do the 1031 exchange on that portion of my home that I use for my business. You might be able to do that. You should check with your CPA first. My CPA did the computations about taking the credit versus the depreciation and the absolute write-off on the office portion. And he said, Phil, it isn't that much different. Why would you want to recapture depreciation? Just go ahead and take the credit, and that's all there is to it. And we'll set it up the right way. You also will see other types of situations where people will live upstairs, for example, on the residential portion, but downstairs is a commercial or a retail portion. So those people would do exactly what we just talked about. They'd use the 121 on the principal residence and the 1031 on the sale of the property, the commercial portion of that sale, and do a 1031 exchange on that. Same thing applies, pretty much the same. It doesn't matter if it's a duplex or a fourplex or a 10plex, whatever you live in, as long as you qualify for it, you get the 121 up to the 250 or 500. On the other portion, you get to do a full 1031 tax deferred exchange.
Hey, Cheryl's got a great question, and I'm going to throw this one over to Adam Nishikawa. What happens if your spouse passes? Let's say you live in just your primary residence and your spouse passes. What kind of tax implication are we looking out for there, Adam?
Yeah, so for community property states, and it's going to be state specific, but you're likely to get a step up in basis on the property, which means from the date of death, you actually get the tax benefit of, unfortunately, your spouse has passed away, but the good news is you get a step up in basis to the date of death, meaning if you sell that property right the day after they have passed away, you actually don't have to pay any of those capital gains tax. They basically took them to the grave with them. As we all know, that's the only way to get away from paying taxes.
Yeah, so hey, Cheryl, so if your basis with your spouse is $100,000 and the spouse passes and the property is now worth $1 million, your new basis is $1 million. If you sell the property above $1 million, you will get your homeowner's exemption for your 250 because you're single now, unless you sell the property in the same year that the spouse passed. So that step up in basis is fantastic. And in California, it's even better because you get a full step up in basis with just one spouse passing.
Yep, be careful. Make sure that your client is speaking to her estate planning attorney, that they have it in some kind of a trust, and a revocable trust is probably the best way to go, but that will ensure for the full step up. I've seen too many situations where they only got a half step up in basis on the principal residence because the vesting, the ownership on the deed was not allowing for the full step up. Talk to your CPA, talk to your estate planning attorney, make sure you have it right, and don't wait till after a passing because it's too late in many of those situations.
Now, we have another interesting question, and I want to make sure that I understand it. So the question is, can a 5-unit building be used if you live in it for 2 years? So you can take the homeowner's exemption on the unit you live in out of the 5-unit building, okay? But you can't claim the whole thing as your primary if you have tenants in the other units, all right? So you're only going to get the homeowner's exemption on the actual physical unit or the value of the unit that you live in. So let me know if that was your specific question. I think it was Payam, if you wanted to elaborate or if we got that one correct. Okay, So a couple other questions here. Do you get the full step up in basis, Phil, on only your primary residence, or does it work for investment properties too?
Investment properties as well. Again, it has to be in that trust. There are other ways of doing it, but again, that's why you hire an estate planning attorney, not you, but your client. And the bottom line is that it applies to any real estate that they own.
Okay. And then I think I want to talk about this one too. Eli has a good question. So we've got a property here, Eli, that I think you said is a second home or a rental. Okay, so let's just call it a rental for right now. So it's been a rental for 20 years, and then we go ahead and we convert it to a primary. Adam Nishikawa, what are we going to do from a tax perspective if we've converted a rental into a primary?
Yeah, so your CPA is actually going to be doing a proration of the benefit based on the use of the property. So unfortunately, you don't get the full 22 years of deductions and benefits as the primary residence. You only get the 2 years of that portion of time. And so unfortunately, it's prorated. So you have to talk to your CPA and find out how much you qualify for that amount of time.
Yeah, so this one, Eli, gets a little bit complicated in terms of kind of crunching the numbers. But the longer it's been a rental, the worse the proration is going to work for you, because what you've done is you've converted your rental into a primary, but you've only used the primary, in my example here, 2 out of 22 years, which it's a little bit more or a little bit less than 1/10 of the time. So they're going to take 1/10 of your gain and allocate that to the primary residence use. And then you can take up to 500,000 if you're married of the exemption, but you probably won't be able to allocate that much gain to it. So not the best thing. And what California, or what the government did, not just California, the federal government said, hey, too many people are moving into the rentals and not paying taxes. So we're going to allow it to continue, but we're going to prorate kind of the exemption there. So still allows you some tax mitigation, but not completely.
In 2005, Congress, or it was 2004, 2005, Congress created the 5-year hold rule as a result of that concern that Leonard was just talking about. Then in 2009, what happened is they passed the conversion rule that says if you sold the property, or I'm sorry, if you converted the property into your principal residence prior to 2009, you still get the full benefit. But if you did the conversion on January 1st, 2009 or later, then you get into this situation that both Adam and Leonard was talking about. It's a good question for the tax people. You got to put the onus on them, because you and I, we don't, our E&O doesn't cover giving out bad tax information. So be careful.
We'll tell you. We just want you to confirm with your CPA, okay? Because these tax principles are really important to know, and you need to know what questions to ask your CPA. All right, Noreen's got a really good question. So Noreen says, well, geez, I live in, my top unit and I rent my bottom unit out. How do I figure out, the prorations? Typically what's going to happen is that it's done based on square footage. So if the square footage are equal between the top and the bottom, you're going to just say, hey, 50% of the value is allocated to the top and 50% of the value is allocated to the bottom. So your CPA is going to do this when you start depreciating the property. They're going to say, okay, well, we're going to look at the square footage between the 2 units, and we're just going to depreciate the value allocated to the rental component. Now you might say, well, geez, the top unit's worth way more because it's got sweeping views of the ocean, and the bottom unit is, it's got a view of the garbage can. Well, typically it's done based on square footage. It's not going to take into factors like the view. So you're going to figure that out with your CPA once you put the property in service as a rental, and we're just going to kind of go with those percentages when we sell the property. Okay, very good questions. I love the interaction, but let's kind of keep moving forward here. You've learned about the 2 tax laws. You've got section 1031, you got section 121. Sometimes you can use them together, But on a pure investment property, if you're gonna just do a 1031 exchange, what do you gotta do? Well, guideline number one is that your properties must be eligible for 1031 exchange. Phil, what kind of properties are eligible? Where are they eligible? Is it a national thing? Is it just California? Give us the rundown.
Good news is you can exchange your California property for any property anywhere in the United States of America. In some cases, you can go to a U.S. territory like Guam, Puerto Rico, U.S. Virgin Islands. Just be careful, make sure it qualifies, speak to your CPA about that. Secondly, the government says it could only be investment property that's exchanged. Well, how do you define investment properties? There's only one of three ways of doing it. Number one, you've been renting it out and declaring it on your tax return on your Schedule E for at least the last couple of years. Number two, by the way, can I rent to my child or an elderly parent? The answer is yes, as long as it's in their related party, close to fair market rent. Second question is, what if I haven't been renting it out? What if it's my place of business? Then the answer is yes, you can do a 1031 exchange. You can exchange that property into any other investment property. In fact, it says it has to be a like-kind property. And I'll get into that in just a second. The third kind of property that you could exchange in and out of is vacant land. You say, well, I don't charge rent on vacant land, and I'm certainly not running a business out of vacant land. Maybe I put pumpkins on it, in October and Christmas trees on it in December, but really it's just vacant land. Or I charge people a horrific amount of money to park during the football games, for like $100 a spot or whatever it is. But other than that, it's just vacant land. And the answer is it doesn't matter. If you're holding it for appreciation purposes for at least 2 years, all three of these properties are considered as investment real estate. Now you can go into any other investment real estate. For example, people call me up and say, well, I'm gonna sell a single family rental. Can I buy a 5-unit building? The answer is yes, because both are considered as investment. What if, can I go from commercial to residential or the other way around? The answer is yes, because both are considered or defined as investment property. So you can mix and match. What does not qualify as investment property is your personal residence, your second home, your vacation home. Be careful with those because they're going to have a good heart-to-heart with their CPA based on the way they've been reporting it on their tax return. So,
hey, Phil, sorry to interrupt. What if I have an investor who just completed a flip and they bought it, fixed it up, and now they're selling it for a profit. They bought it because, hey, that was a good investment, right? Can I do an exchange on my quick flip?
Most CPAs will say no. Some will say yes. I personally recommend that they speak to their CPA. If they give them the okay, then, like I said, we don't give legal advice and tax advice. So we will then facilitate the exchange, but it's at their own risk. But generally speaking, they haven't been renting it out. They haven't held it very long. And certainly it hasn't been their place of business. So generally speaking, most tax people say no, but some do yes. So if they get the answer they want and they want to exchange it, then, we'll facilitate it for them, but be careful because you and I just can't say yes. So just have to be careful.
Yeah, Phil's being a little gracious there. I'm gonna say you're gonna have a problem if you get audited, right? Because the government doesn't want to see that inventory exchange. If you're a developer, quick flipper, I've seen people take very aggressive tax positions and try to exchange it and just cross their fingers and hope they don't get audited. But it's not something that we would say, hey, yeah, this looks and smells good. Those quick flips, I don't think you should be exchanging. But if you want to roll the dice, you can do whatever you want, right? We're not the tax police, I think, is what Phil's trying to get at, and talk to the CPA. All right, so good explanation. Now, I think there was one question here. I think someone asked. I think Phil answered. So, can you rent to a family member? You definitely can. You just want to make sure you're paying them fair market value or close to fair market value rents. You don't want to rent to your college-age daughter for $17 a month, right? When all the comparables are at $2,000 a month. Make it look and smell like a real rental. And if you do that, you're not going to have a problem with the IRS.
Especially if there's roommates.
Yeah, charge those roommates, right?
Yeah.
Okay, here's a tricky one. Adam Nishikawa, this comes up all the time, right? People say to me, well, geez, I'm selling my $1 million property, but I only have $300,000 in profit, so I only have to buy a $300,000 property in my exchange, right? What do you say to that, Nishikawa?
Good luck.
Yeah, the formula for full tax deferral is you're going to take your gross sale price and you're going to deduct the escrow, title, your commissions, our fee, all of the non-reoccurring closing costs from the sale can be deducted. Whatever you arrive at after you deduct those closing costs, that's your target replacement value for full tax deferral. So that means you're rolling in all of the cash that comes from the sale and you're getting a new loan of equal or greater value, or bringing in the cash equivalent of the loan into the purchase, and or the seller's carrying back the loan amount that you need for the purchase. So basically you need to reinvest all the cash and buy a property of equal or greater value.
Yeah, and this is a big one. This came up. We had a client sell a property for $5 million recently, and I'm just going to use some easy to follow numbers. They sold for $5 million. They had $3 million in sale proceeds. When they went to buy their next property, they only put $2 million down, and they got a bigger loan. And they said, well, geez, we want that $1 million that's left over just to come back to us. Can they do that, Adam Nishikawa?
Absolutely not. So you can't change your debt to equity ratios from the relinquished property to the purchased property. So we do not recommend, buying down your loan into a lower amount or increasing the debt just to take some cash, because that cash is going to be taxable immediately as soon as you receive it. So it's not something we recommend. If you need to pull some money out of the property at some point, you should do it after the 1031 exchange has been completed.
Yeah, and if you're a loan agent, don't advise your client, hey, get the biggest loan you can because the rates are good right now, if they're doing an exchange, right? Because even though you might have a good loan product for 10% or 20% down on this investment property, the exchange client might need to put 50% down because that's how much cash they have sitting in their exchange account, all right? So realtors, that's something you guys probably don't get as involved in, but I've seen these mistakes happen where the loan agent says, oh yeah, just put 20% down because we've got a really good loan product right now, but you need to use all that cash. So rule of thumb, just tell them, hey, just don't forget all your cash needs to be the down payment and just replace what you bought. If you sold for $1 million, you got to buy for $1 million. Now, Phil, can they buy multiple properties?
Absolutely. And I always encourage people to diversify if they can and acquire multiple properties, because when inflation happens, they're now appreciating with 3 properties as opposed to all that equity in 1 property. So many investors are doing that. You can buy in different states. They don't all have to be in the same state. They can be different types of properties. Maybe you're selling residential, you're going to buy 1 commercial, 1 industrial, 1 vacant lot. As long as you combine them, and you, like Adam said, you're acquiring for roughly equal or more than what you're selling, and you're using all the cash. That will work, and that's a great way to go.
Yeah, so you can sell 1, you can buy 2, not a problem. So Adam Nishikawa, we've got another question, but the flip of that, can you sell 2 to buy 1?
Absolutely. So you're setting up 2 essentially separate exchanges, 1 for each of those relinquished properties. And the reason being is because you're actually going to have a different time frame for each property. So we're going to go over time frames in a bit, but basically from the close of escrow on the sale, the first sale is the beginning of your time frame to complete your 1031 exchange. And so you just want to make sure you create realistic expectations with your client. If they're selling 1 ragtag condo that's got a huge HOA fee and then 1 pristine single family home, it's, you're more likely to sell that single family home before you can get rid of that condo. So you just want to make sure you can time things as close together as possible to give you the best chance of combining those proceeds.
Yeah, and that's a really good point, Adam. So we've got property A here, and property B. We're going to sell them both and use all of the money from both to exchange into this big, beautiful rental that we want to buy. The problem is, this property is kind of a dog, and property B, it's beautiful. And we've already got people who are interested. So what we kind of recommend people do in this situation is your exchange time frame starts the day you close escrow on the first property. If you get an all cash offer for a 7-day close on this big, beautiful property that everybody wants, that might not be a good offer for you. Because if you take that offer, you're closing in 7 days and your exchange time frame starts. You got to now hustle to go out and get this dog sold. So one of the things that we tell people to do is, hey, get those properties on the market. Maybe put property A on the market first, since it's kind of the yucky one, and see how the interest is, right? If you do put them both on the market at the same time and B gets an offer right away, maybe ask for a flexible close of escrow date. So instead of closing in 7 days, say, well, geez, we'll close in 30 or 60 days, maybe even 90, so that you, the exchanger and the realtor helping out that exchanger, control the start of your exchange, okay? So keep kind of that in mind, because that's going to help you when you're doing a multi-property exchange. The controlling of that escrow close date is really, hopefully it's up to you. Markets change, so maybe you just have to take, that 7-day offer, but if you can control that escrow, you're going to be in a much better position to successfully complete your exchange. Okay, and it's important, right? Because we do have an exchange time frame. Phil, what is our time frame when we do our 1031 exchange?
ASAP. Basically, what happens is that once again, you have to do an exchange to get these. And the second thing is you have to sign up before escrow closes with us. We have to initiate this with the escrow officer, set up the exchange, and have the client do the DocuSign. So now they're in a position to utilize this time period. First one is they have 180 days from the date that they close the sale. So if they close today, which is the 24th, tomorrow's the 25th, tomorrow the 25th is day one of 180 days to take possession, to close, to take the benefits and the burdens of the new acquisition. We call it close of escrow here in California. Number one. Number two, if 180 days lands on a weekend or a holiday, there's no next business day, folks. It's that day or before. There's no extensions for that. So you have to be very cognizant of the fact that you've got to close before that 180 day if it lands on a weekend or a holiday. Number two, the government also said that you have to identify what you're going to buy no later than 45 days after that sale has closed, the first 45 days of that 180-day period. You can mix and match. Under the 3-property rule, you can name up to 3 properties, right? But what if you need to change that and you need to get some off and put some new ones on that just got listed, just got on the market, just became for sale? The answer is you can change your identification 100 times, but not after day 45. And the bottom line is you've just got to know what you're going to acquire. My suggestion is don't identify and take off and put on and because you can't go over 3. So why not just wait and towards the end of the 45 days, submit your identification. And the bottom line is the identification usually comes to us. So you're identifying to your qualified intermediary. And the bottom line is that you can go into escrow on these purchase properties even before you close your sale. So that's never a problem because you can close the next day or simultaneously. But obviously you don't want to rush it. You want to make sure you've got the right properties. And if you close within the 45 days, you don't technically need to identify because a closed escrow in an exchange is the perfect identification. But if you cannot close it in that 45 days, you must identify those properties.
Yeah, and I'm going to have Adam go over the options for identification. But before we do that, I do want to mention, so it's a good time to be an exchanger right now. And the reason why is because the inventory has been tight for a very long time. And investors, a lot of them have been hesitating to sell because they didn't know what the heck to buy. And the market's changed, right? Cheryl just mentioned to me over the chat here, she said, no properties are getting offers right away currently, which you think, well, geez, that might be a bad thing. But if you're an investor and you can sell your property, you have a lot more to choose from. You can be a little bit more discerning and you can negotiate maybe a little bit better, right? So if you want to exchange at this point, if you want to start talking to your clients about doing exchanges, it's a good time to be exchanging. I've talked to a ton of realtors who are saying, oh, the business is terrible right now. And it kind of is, but guess what? Our business isn't that bad, right? We're having a pretty darn good month in the 1031 exchange world right now because there are a lot more options for investors to exchange into. So, we do deals in good and bad markets because there's opportunity for investors in good and bad markets. So yes, it's challenging to go out and do an exchange on this compacted time frame where you close escrow and then you got 45 days and you got to close by 180. But I think it's a great opportunity right now to start talking to your exchange clients because I'll tell you, it's a good time to be doing an exchange right now.
Absolutely. And Leonard, can I just add one more thing to that?
Yeah, absolutely, of course.
In all these years since 1982 that I've been in the title and then the exchange end of things, I can tell you there are pockets. There are pockets where it is slower. There are also pockets that it'll stay on the market for 2 days and it's in escrow. So it just depends where you're looking, and that's why it's so important not just to say, well, I'm going to do an exchange. You need to start looking for property immediately as soon as you put that for sale sign up on that relinquished property, because you don't know that maybe that area you're going into, they're flying off the shelf. So it's wise to just check out the pockets where it's busy versus the ones where it's a little slower.
Yeah, and imagine if you have a client that owns a property in a pocket that Phil was mentioning is busy. Okay, get them to sell that property and then they can go out and diversify into maybe these less busy areas and get great deals, increase their cash flow, and just have a great kind of diversified portfolio now. So really good opportunity, I think, right now. But let's talk about identification. So let's not get too sidetracked. Adam, talk me through filling out the ID letter and kind of my options when I do so.
Yeah, of course. So this is a photocopy of our identification letter. There's really 3 ways to do an identification. In my opinion, there's really only 2 ways to do an identification. So the first option is called the 3 property rule. This is like 98% of our deals. Our clients use the 3 property rule. This means that they can identify up to 3 potential replacement properties, regardless of fair market value. So if you sell for $1 million, it doesn't matter if you identify 3 properties worth $20 million. It doesn't matter, as long as it's 3 addresses. You can't just identify the zip code to us. It can't be 3 zip codes. It has to be 3 actual addresses and descriptions of the property. The next option is called the 200% rule. So this is more for our investors that are looking to diversify their portfolio. Maybe they're going from California to a state where they can buy a lot of property like Alabama or Tennessee, and they want to buy a lot of different properties. Well, this 200% rule restricts your identification to 200% of your sale price. So if you sell for $1 million, you can identify up to $2 million of real estate, and that's aggregate fair market value. So that means that all 6 of these properties have to add up to equal to or less than $2 million. And so it does restrict you, but for some investors, it gives you that opportunity to go diversify and find a whole lot of properties to buy. And then last but not least, there's something called the 95% rule. It's more like an exception than a rule, but basically you can break both of the first 2 rules as long as you can close on 95% of your identified properties. So if you think about that, that means that if you were to sell 1 property and identify 10 properties, if you don't close on all 10 properties, it's a failed exchange. You actually have to pay taxes. So unless you can close escrow on all of those properties, I would say before the 45th day, I would not recommend pushing the 95% exception.
Hey, Phil, you've got the most gray hair out of all of us. So
Oh, you noticed that, huh?
it means you've seen the most deals. Have you seen anyone use the 95% exception rule?
I actually have a number of them, but it's rare. It's
Yeah.
usually in agricultural type properties that they're acquiring. It could be a farm, well, it's ag, I can't think of another type of property. Well, whatever it is, it ranch land, that's what it is. And I've seen people do it. I've actually been called in by some CPAs who said they were having a problem with the franchise tax board with the 95% rule. So it happens, but for those of you who are watching this today, chances are pretty good. If you're just sticking in the regular basic residential area or even the commercial end of things, you probably will never see that. Very few of you will see the 200% rule, frankly. And that's also a good one for the DSTs, the Delaware Statutory Trust Properties. That's when you're going to buy lots of little fractions of like a piece of a pie on some very large properties. You probably will go into the 200% rule. Very rare do you see a 200% situation where you have to buy 95% because you exceeded the 200% rule. And by the way, that's the value, 95% of the value. So be careful because the government is tricky and they will look for anything, especially the state of California. So be careful because I would rather be audited by the IRS than the California Franchise Tax Board. And most CPAs would tell you the same thing. So they'll look for anything they can to get money.
Yeah, and when you work with a company, you're assigned an exchange officer, and you're going to be in close communication with the exchange officer, especially when it's getting close to your identification deadline. And they're going to explain these rules to the client, make sure that they understand everything, and make sure that they're identifying properly. But before we move on, I don't know if you guys caught this, but Adam Nishikawa called this a photocopy. And I don't know if there's some young guys on the call here today, but I don't know if some 20-somethings even know what a photocopy is, but this is a screenshot, Adam, not a photocopy.
That's my line, not yours.
I just renewed my passport, so I had it fresh in my mind.
Yeah. Okay. I wanted to throw this in here because Phil was talking about, geez, you never get extensions to these timeframes. And in the olden days, you never got extensions, ever. I mean, when I was doing this back in early 2000s, you just didn't ever get an extension. What happened though is California is starting to get fires every season, and we're starting to get floods in places like Florida and hurricanes every single year. And when those disasters happen, the federal government will issue a presidential disaster declaration. And when that happens, we have extensions for our tax filings and our 1031 exchanges. So Phil, why don't you talk them through this most recent federal disaster declaration that we got with the Los Angeles fires?
Yeah, first thing I want to just warn you is that because there is what you think is a disaster may not be with the IRS.
Yeah, great point.
So be careful. Always check with us first, and we'll tell you if they filed this. Today, the last one is really applicable to us because it's almost July, and here we are. If you look at if the relinquished property closes, it's the last bullet point, after April 18th, but before August 31st, and we're right in that category bracket right now, you receive an extension on your ID deadline from the 45 days as much as to October 15th. But as right now, that's a lot more than 45 days. And you'll have 180 days to complete the exchange. So the bottom line is, this is a good time to get listed, especially if you can get those properties to sell quickly. They can get additional time to look for their upleg, their replacement property. They'll just have to communicate this with their CPA. Again, you and I don't give tax advice or legal advice. By the same token, we want their CPA to feel comfortable with this and say, yes, you do qualify for this. And we'll give you a copy of this flyer that we have. In fact, you'll see it on our website. But it is there, and people are getting those extensions.
Yeah, I think you never want to kind of profit from tragedy, but if you're an investor and you reside in Los Angeles County, this is probably one of the best times to do an exchange because that deadline is pushed out. So, talk to your investors about that possibility. If they've been sitting on the sidelines thinking, well, geez, I want to exchange, but I want to, maybe do it next year, have a conversation with them. Maybe it's a good time to do it this year. Okay, guys, but we're approaching 3 o'clock, and I like to kind of start on time and end on time. So we're going to go ahead and just kind of try to answer some of these questions that have been sent over to us that we haven't had a chance to address yet. And I know that a couple of you have exchanges coming up. I think Cynthia has got one, and she wanted to get our contact information. So on the board here, you've got our contact information. One of the things that I like to state during all of my presentations is that we usually dump a lot of information at you, right? And for some of you, it might be the first time that you've heard a talk about 1031 exchange, and you might be overwhelmed, or you might be like me, you listen to a presentation and then you walk out the door and you forget 95% of it. That's okay, okay? Really, if you are an investor or a real estate agent, the only thing you need to know about 1031 exchange is listed on the slide right here, okay? And this is your team and our phone numbers, all right? So you guys can call Phil, you can call Adam, you can call me anytime. But really, if you're in Southern California, the only thing that you need to know about 1031 exchange is the guru here, Phil, 26 years, and the guru to be, Adam, coming up here in his, I think his 10th year, right? So if you guys don't remember a thing, that's okay, as long as you don't forget your teammates here, Phil and Adam in Southern California, all right? So please do not leave this call without typing one of these guys' phone numbers into your cell phone if you don't already have it, okay? Because that's all you need to know. And all of these questions that you guys are throwing at us, we're gonna answer them, I promise you, but make sure you put those phone numbers in your cell phone ASAP.
Leonard, many times the agent won't be able to explain this in totality to the client. Adam or I will take that phone call and we will do that for them. We're here to be a support as part of your team so that you would feel comfortable talking about this and saying, I have a team that works with me, they'll talk with you. And believe me, Adam and I are on the phone constantly with clients answering their 1031 exchange questions without any obligation. We're happy to do that for you.
Okay, I'm gonna pepper you guys with questions now. It's almost 3 o'clock, so we understand if some of you have to leave, and we appreciate your time. But if you have a little bit of extra time and you wanna listen to all of these questions get answered, stay on. So we're gonna start right now with Richard asked about a 721 UPREIT. Is that an acceptable option, and what are the pros and cons? So I'm going to take this one, guys, real quick. A 721 UPREIT is not going to be an option for almost every one of you, because in a 721 UPREIT, a REIT has to buy your property in exchange for shares of their REIT. Now, most of us own rental homes or apartment buildings, and REITs typically don't buy mom and pop owned investment properties. They buy institutional grade properties. So 99.9% of us are never going to deal with a 721 UPREIT unless we own some type of institutional grade property that the REIT is interested in. Now, there's a two-step process to get into an UPREIT, where you first exchange into a slice of an institutional grade property through a DST, and then the REIT acquires the DST. So Richard, very good question. It's kind of complex. In order to take advantage of that, we can introduce you to people who specialize in that kind of two-step process if you want more information, but good question. Okay, I'm gonna throw a softball at you, Adam. Cynthia wants to know the cost of our services.
Yeah, of course. So if you're looking to do a normal delayed exchange, it's just a flat fee of $1,250. That's for one sale and up to 3 purchases anywhere in the United States. So if you want to help me buy something in Alaska, we're happy to help work with that.
Okay.
That's 3 replacements. Most companies don't do that, folks. They only give you 1 sale, 1 purchase. So you get 3 at this company. I think that's a good deal.
Yeah, and there's cheaper options out there, I'll tell you that, just like everything, but there's no better option, right? One of the things that we see is there's new companies that start up all the time, and they really just go out and kind of get business by really decreasing their fee. The problem with that is you're working with people who they just might not have been around a lot, right? So our staff, I mean, Phil's the oldest guy in the industry, right? And you get to work with Phil. I mean, that's worth double the price.
It's important. And ask your escrow officer about trying to contact them when you're ready to close, how quickly they're willing to fund and how many phone calls does that take to happen. So Leonard knows what he's talking about, folks.
All right, so this is a good one, and I'll let whoever, Adam or Phil, whoever wants to take this. This question gets asked all the time. I got to put money, and this is Sylvia from a while back in the presentation. Sylvia's got to put, or her client's got to put $10,000 into the property prior to selling it so that she can make it look nice. How do we account for those expenses? Can we pay ourselves back at close of escrow, or what do we do, guys?
Well, like Adam was saying before, there's recurring and there's non-recurring closing costs. If in your sale, the buyer asks you to do this, to either credit them or give them cash back, you want to pay for those repairs or replacements, that is allowable because it's a contractual condition of sale. When there's a contractual request to fix or refund or whatever, it's considered non-recurring. But if you do this beforehand, it's considered recurring and not allowed to come out of the proceeds of the sale. So be careful.
Yeah, rule of thumb, if you're just putting money into a property, it's going to be accounted for as either an expense written off against rental income or a capital improvement, which is going to increase the basis of the property. And your CPA is going to kind of determine that because there's really weird accounting rules on how you classify those dollars that go into improving properties. But rule of thumb, if you're just preparing your property for sale and you spent 10 grand, that money is in the property now. You don't get to pay yourself back with tax-free dollars when you close in a 1031 exchange.
Good answer.
Okay. Nishikawa, do I have to notify the buyer that I'm doing an exchange when I'm selling my property?
Yeah, so this is one of those questions agents ask me all the time. They're like, well, we want to do a 1031 exchange, but we don't necessarily want to declare it yet. And so the correct answer is you're going to have to tell the buyers eventually because they're going to have to sign what is called a notice of assignment, which is something that lets them know that, hey, buyer to cooperate with seller's 1031 exchange at no cost to buyer, right? Or the other way around, seller to cooperate with buyer's 1031 exchange at no cost to seller. So basically, the short answer is yes, you are going to have to notify them that this is a 1031 exchange. But do I really see that being an issue? No. I mean, 99% of the time, it's not going to create an issue. The only time I've seen it create an issue was when I got notified the day escrow was closing and the buyer was freaking out because they've never been part of the 1031 exchange, and they had to sign, a notice of assignment. So really, it's not going to impact your exchange, but yes, you do need to notify them that you're doing the exchange.
Yeah, well answered. Phil, I'm going to lob this one to you. This is from Sharon. How long does the property need to be held before exchanging again? So you did exchange, you bought a new property. How long do I need to season that before I can exchange it again?
The simple answer is 2 years. Now, some tax people will tell you 2 tax years. That means the rest of 25 and all of 26. It just depends on your CPA. Always check with them. I've had some people like, well, you brought up the flipping thing. That's another situation. It needs to be seasoned. The government needs to see a couple of tax returns showing that on your Schedule E, this is an investment property, which means it's eligible for a 1031 exchange when you sell it.
Well answered. Thanks, Phil. I'm going to take this next one because it's a little hard to explain, but we have an adult parent who has a rental property. Okay, they want to buy a new property with their kid so that the kid can live in it. Is that allowed? The answer is yes. The easiest way to do it is the parents just sell the property, do a 1031 exchange, buy the new property and rent it to the kid. Okay, that's the easiest way to do it. That's what I recommend. Have the kid pay you fair market value rent, report that rent on your taxes for 2 years, and you're good to go, no issues. Now, with that said, 99% of the time when people ask this question, the next thing that comes up is they say, well, geez, what if my kid wants to be on title with me? Okay, that can happen, but in a 1031 exchange, you need to own enough of the new property to satisfy your exchange amount. Okay, so in buying this property with your kid, you might need to own 90% of it so that you own enough real estate. That means your kid can own the other 10%. Right, so we will work with you to kind of figure out how much of the new property you need to own so that you don't have a problem in your 1031 exchange. Now, the short answer is yeah, you can absolutely buy with your kid. You can add your kid to title, but you need to do it carefully so that it doesn't result in a tax liability to you. And the kid needs to be okay with this, okay? 10% owner, sometime the kid can be 50% owner. Sometimes we have to recommend that the child is only 1% owner, all right? Ideally, you don't even have the kid on title, right? Just for exchange purposes, make it clean. But a lot of times those kids, they really, really want to be on title. We get it. There's a way to do it, but we need to be careful.
And if you go into, for example, an 80-20 or 70-30 situation where you, through your exchange, you bought enough property to substantiate it, and they're going to be on the 30% and they want to utilize it as their principal residence, they still have to pay you fair market rent on that 70% that you own. So be careful. Work with a good CPA that will help you with that.
Yeah, but it happens. It's happening all the time because our 30-year-old kids, they haven't saved enough money for a, $1.5 million down payment on a down payment on a $1.5 million house yet. So they're going to mom and dad and say, hey, we need help. And mom and dad say, well, geez, we've got this rental. Let's exchange into it with the kid. And we see this all the time. If you've got clients who are doing that, want to do it, can be a great plan, but we need to do it right. Okay. I think that addressed a few of you guys with your questions there. I think if you have specific other questions about our fees, fund security, things like that, happy to address you. We've got all kinds of documentation to help you explain fees to our clients or your clients, and in multi-property exchange, things like that. We do offer discounts. So Cynthia, if you've got a client selling multiple properties, Phil and Adam can work with you on the sale of 3, get you good discounts involved as well. I think one question was, hey, Phil, how do we know you're not going to take our money to Mexico?
Well, because I can't find a U-Haul that big to put the thing on and drive. No, the real answer is that's why we have bonding, errors and omissions insurance. We have every time there's a penny taken out of that account, we have a sweep account, or I should say a computer that generates an email to the client to tell them there was a nickel or a dime or there was $500,000 taken out of that account, and there's always an accounting of that. You always know where your funds are. You always can sleep at night because that's the way it has to be, because we don't want to be part of the news or asset exchange company ran away with X amount of money or properties. So we really work closely with the client to make sure that they can sleep at night.
Yeah, we don't want to be bunkmates in prison with anybody, right? So you guys, I think we've kind of gone quite over our time frame here. It's 3:11. We appreciate your hanging out with us for a little bit over the time frame. If you guys need any other information, I encourage you to reach out directly to either Phil or Adam. I'm always available as well, but these two guys are your team leads in Southern California. So thank you all very much. We're going to go ahead and sign out now. Have a fantastic day, everybody, and we look forward to working with all of you guys soon.
And if you'd like an office presentation, Adam and I will be happy to come and do a workshop for you so you can feel that you can ask more questions and you'll be comfortable in your own setting. Happy to do that.
Yep, absolutely. Thanks, guys. Take care, everyone.